again, the U.S. market is being flooded with foreign capital inflow, which is going to drive everything higher, regardless of whether or not domestic investors are actually putting money to work, which they're not. Some of the trend following strategies, because they're tied to realized volatility, they've been coming back into the market, and they're expected to buy more because realized volatility is back below about 9 or 10, even though implied is about 11 or 12. So if it realizes going back to 8 or 9, which means that those trend following strategies, which have a lot of money tied to them, are going to be pushing the equity market even higher going forward. Of things that are possible, I mean, the equity market is trading at a relatively rich PE. So as the S&P approaches 2,900, we're looking at forward PEs of about 17.4%, which lower the equity yield in the U.S. significantly. I can't see a situation where the market goes any higher than maybe 3,000, and then probably it eventually goes down. But the market's more likely to hit new highs than it is to substantially sell off over the course of the next couple of months or couple of weeks. But first quarter earnings could be interesting. Like I said, the share buybacks are completely, you can't buy back or purchase shares. So unless foreigners have to come in each month and finance the U.S. current account deficit, which they will, unless they continue to keep putting money into portfolio channel and financing the U.S. current account by buying U.S. assets, meaning equities and corporate bonds, we're not going to see a huge fall off, because that's about $150 billion worth of financing that has to come in, or a little bit under $150 billion each month that has to come in and finance the widening deficit. So foreigners have to finance that every month, and the U.S. has to get a couple hundred, about 100. I think it's about 100. I want to say about 120 $1 billion of financing that we need each month, and that money is going to come directly into the equity market and also the bond market. So the chances of the equity market moving higher, even without the share repurchases that we're putting, that we're increasing the value of equities, you still have another large buyer, and the large buyer now is going to be the foreigners coming in, who are not necessarily coming in because they love U.S. assets, and they don't think that they think that the U.S. economy is better, but the differentials in all the various markets and the fact that the U.S. needs the financing means that it's much more likely that we see the equity market move to a new high than we do see it move lower over the course of the next couple of months, just because of the foreign financing. Like I said, though, at some point, because of the way that the global trading system works, the current account deficit and those trade deficits are not financed in perpetuity. They eventually, at some point, reach a peak, and that peak is probably going to be reached in the third quarter. And again, all they're doing right now is influencing the wealth effect. So the more that they keep pushing up the equity market, and actually they're helping the risk parity trades. They're also helping the equity vol targeting trades. So they're influencing the algos now, and the algos are buying nonstop. The algos are adding leverage and buying nonstop. But it's going to influence consumers to actually purchase more, and that's going to again have a negative effect on the trade deficit, and also a negative effect on the current account balance, which has to be financed. But eventually that runs its course, and the minute that runs its course, if that money's coming into the portfolio channel, foreigners can take out that money very, very quickly, and they will take out that money very, very quickly, and the equity market will be probably lower by the end of the year, and volatility will come back and will be a little bit higher than it is currently now. So this is not going to last forever. Like the tightness in the corporate bond market, the tightness in the high yield market, the shift over to risk assets, it's just not something that's sustainable over the course of the next 6 to 12 months. So I guess the only thing that I was going to say is that if you were to put on puts going out for 12 months, there's no way that you're not going to make money on those, and there's no way that you're not going to be able to return a lot of money on those. And then the